Hi, good afternoon. Welcome to Oxford for our latest in our webinar series. So today we are looking at real estate and in particular the macro effects of the current COVID crisis with Professor Andrew Baum and Sabina Kalyan, Chief Economist at CBRE Global Investors. So apologies for us starting this webinar a few minutes late. We're having a couple of technical issues. So Andrew Baum will be joining us in a couple of moments, hopefully. Have a couple of issues there, but we thought we'd crack on because we're a few minutes late. So we have Sabina Kalyan online, and we'll pass over to her in a moment. A couple of housekeeping rules, if you like, for how the format will work today. So we have this session to go until about 2 o'clock, so just under an hour now. We will have a presentation first of all with Sabina, and then we will have a Q&A session at the end. So we have over 350 people on the line now, so all participants will be on mute. So if you have any questions, then please enter those into the Q&A panel, which you should see in front of you, and we'll try to address as many of those as we can at the end. So just to introduce our panel today, and so Andrew Baum, who's a professor of practice in real estate at the Saïd Business School, and Andrew also leads the Oxford Future of Real Estate research project at the school. So this is really to kind of bring together different companies to research different aspects of real estate investment. So in particular, over the last year, we have been looking at prop tech, tokenization, future transactions, and current projects are looking very much at things like climate and sustainability. Sabina Kalyan is our panelist today. So Sabina is an Oxford graduate and is the Global Head of Strategy and Research and Global Chief Economist at CBRE Global Investors, and an Associate Fellow at the Business School, and regular speaker on the Oxford Real Estate Executive Programme, which we'll tell you a little bit more about at the end as well. So Sabina, while we're waiting for Andrew to dial in, shall we push forward through to your slides, and then we can kind of go through that. Sabina, can you hear me?
Yeah. Perfect. Thank you very much. So afternoon all. I suppose we're all getting used to this new way of working. I thought I'd take you through a very sort of short version of our global house views for H1 2020. We normally, in the normal course of business, we do this twice a year, so around February, March, and then September, October. And it's really the way in which the strategy and research team gets in touch with all the program and regional CIOs, the PMs, the portfolio managers, the asset managers, and tries to sort of distill the best views of the business for the outlook 5 years ahead. Now, obviously, as we were preparing this one, we got slap bang in the middle of the COVID pandemic. So we will be doing a reforecast in May. So what I'm going to show you is kind of almost the start and the end of the process, which is our current thinking on the macro outlook and where we would see the biggest impact on real estate by sector and region and how that affects our portfolio tilts. But what I'm not going to show you is the middle part, which is the actual quantified real estate returns, rent yields and all that, because we're in the middle of redoing them, well, actually from next week. So if we flick to the next slide, this is nicely now in Oxford colours rather than the lurid CBRE greens, our forecasts for GDP. So people talk a lot at the moment about shapes. Is it V-shaped? Is it W-shaped, U-shaped, L-shaped if you're particularly bearish? This is the Nike swoosh, which a number of people are using. So everyone goes into a synchronized, really nasty recession in the first half of this year. They start to move out, depending on basically how good their public health response was. You can see Korea, which is the top line, has very little of a recession because they obviously didn't lock down their economy. They did it all by track and trace. Within a European context, it's hard to see here with the colours, but the line that pings up first is Germany. So again, moving out of its lockdown quicker. And then poor old Italy, who basically loses 5 years of growth. That's the base case. I guess we'd attach probability to that of something like 50%, which is very low for a base case. And we've got a medium downside scenario, which assumes that the public health response isn't as effective, that you don't get a vaccine anytime soon, and that you see a permanent loss of output. So your bounce back is as strong in a way, but then sort of peters off. And then we're coming up at the moment with a very severe downside, which assumes something like this causes or triggers a credit crunch akin to the GFC, that you have a Eurozone debt crisis, and you really do see substantial losses of output through to 2024. And it's interesting for us as real estate people to try and figure out how that impacts real estate. Obviously, you've got the demand side, which I think is more easy to track onto rents and construction timelines and supply. The far more interesting question is really looking at inflation and interest rates as price takers from the fixed income market, and whether, you know, some of these quote unquote upsides you see being quoted with higher growth but also higher inflation are really good for us. If we go on to the next slide, I thought what might be quite interesting for you all to see is where our forecasts were in that beautiful long lost world pre-COVID to now. So you've got the January numbers in the light beige now, you've got April in dark blue, and the difference in the lurid orange. And you can see in some of these markets, typically the English speaking ones, it's a radical difference, right? You've gone from relatively low unemployment rates, full employment, above full employment, to radical rises. The UK stands out here. And this is all about the technical difference between whether someone being furloughed or having their income subsidised by Rishi Sunak counts as being unemployed or not, but clearly a big impact on the economy. And then, you know, to the right-hand side, you do have places, again, South Korea, Germany, where the impact on unemployment isn't that large. And so obviously one would expect that to translate onto city-level employment stats and whatever the rent demand side looks like in the reforecast. If we go on to the next slide, here we go. This is where it starts to get really interesting, because you see the cost, particularly in the UK, right, of putting those income subsidies in. So again, it's the same thing. You've got the old pre-COVID forecasts in beige, you've got the new ones in blue, and the difference in orange. And you can see the budget surpluses. Take Canada. We thought Canada wouldn't even run a budget deficit in 2020. It's now running a substantial one at sort of 8 to 9% of GDP. The UK's balloons after years of austerity, that's just all been wiped out. And you can see the public debt to GDP ratios underneath. So the UK now gets up to 100% in 2020 and pretty much stays there. Japan was already high, gets higher. Italy, 170% of GDP. I think this debate about how to effectively make sustainable the Italian balance sheet is going to be the big debate over the next few years. And it's either going to result in one of two things. It's either going to result in another sort of jump forward, a leap forward in Eurozone integration, as it should. When you have a currency union, you do need some kind of fiscal transfers. Or it's going to result in some really nasty sort of Eurozone crises over the next 5 years. On to the next slide. I wanted to draw this out for those of you who are focused on Europe in particular, because it seemed to me that over the last sort of, I don't know, maybe 2013, 14 onwards, you'd seen this huge convergence in Eurozone bond yields. I mean, basically after Draghi said he'd do whatever it took to keep the Eurozone together, you'd seen a real compression in sovereign risk premia, and therefore really in cap rates, right? So that this set us up for the boom in Spanish real estate investment, and then latterly into parts of northern Italy as well. But what's striking now when you look at the 5-year bond yield forecasts is how dispersed they are. So I put in the US, UK in there as a comparator, but you see a massive difference on the right-hand side between what you would call the sort of the core northern Eurozone, so the stronger credit markets within there, sort of 5-year average bond yields negative, basically. 0 to negative Germany, Switzerland, phenomenal. Sub 0.5% in the rest of the core. I mean, what kind of prime cap rate are you going to be taking off of those bond yields, one wonders, even with the market demanding a slightly higher credit spread just because of the impairment to the forward NOI growth in this crisis. And then on the left-hand side, you've got the weaker credit market, so Italy, Spain, and the non-Eurozone European markets with much higher bond yields. And it's going to be really interesting when we redo our real estate forecasts, that where our prime yield forecasts were quite homogenous actually prior to COVID, whether we start to now expand those to reflect that more discriminating attitude towards country risk premia. And also, of course, the implication also on this base case, even on the base case, is that the ECB isn't fully successful in dampening the credit spreads of the weaker countries. On to the next slide. So what does this all mean for real estate? As I said, you know, we're in the midst of reforecasting. We were late cycle anyway, right? So a lot of the sort of catch-up rent growth that we'd seen in, you know, whether it was parts of Spain or Berlin, offices, all that was coming to an end anyway. We've tried to here do a very simplistic traffic light signal in advance of coming up with the new numbers. And I want to, in a sense, some of this is really, really obvious, but I want to show you where some of the debate is, because there is debate around this. If we start off with the office market, I think the key phrase I would use is accelerate. So there were a number of structural real estate trends that we were already observing and investing towards that we think have just become, you know, have just accelerated because of COVID. So the idea that the future office that remains investable and attractive is resilient to ESG regulations increasing, provides the kind of flexible, exciting environment that people actually want to come in to experience when they've got the option of staying at home. Well, I think that is just there with a vengeance, right? So we see that accelerating. Suburban offices, who knows? I mean, it just feels like the sort of the densification of office use continues to rise, and that there will be a bit like with retail actually, although maybe not to the same extent. We were already expecting to see a thinning out and a sort of a rise in functional obsolescence of the kind of office that just can't be refitted into that modern best practice. So, you know, I think some people thought offices would get off scot-free because blue chip tenants, you know, big financial houses were still paying our rent. The other thing I would say is we have seen a lot of opportunistic people trying to not pay their rent in offices. So, you know, very well-known names and very prime CBD offices saying, well, you know, can we have a rent-free for this quarter? So the rent collections have been obviously far better than in retail, but people have been opportunistic in that sector. Industrial logistics, of course, everyone sees e-commerce rising, and that's fantastic. We do wonder a little bit about reconfiguration of supply chains. Well, although we try to sort of locate our investments to be close to the consumer, so edge of town infill logistics, one does wonder if supply chain concerns reconfigure some of those routes. So whether that's onshoring or whether that's still offshoring, but reducing dependency on China, which we were seeing a little bit anyway, right, with lower cost locations like Vietnam increasing in importance. I think that could be very interesting. Retail, obviously, the word accelerate is really powerful here. We've just seen a trend that took, you know, that might have taken 2 to 3 years to see the true shakeout in retail happening with a vengeance over 9 months, which arguably, although it's painful to go through, might be a benefit, because as soon as you rebase those rents and rebase what is the institutional investable stock, you can start to see some growth again. Supermarkets, obviously very positive short term. One wonders if this does shift, however, the move to sort of cold storage and food delivery more permanently in those markets that didn't already have it. So that remains to be seen. Resi, I think we have been pleasantly surprised at the rent collections we've seen on our portfolios. In fairness, they tend to cater more to maybe the more affluent white collar worker who's still getting their salary paid and hasn't been put on furlough. We remain very positive on the sector. Student accommodation, I'm conscious I'm on a university hosted call today, I think is really interesting, because let's see if autumn term happens or whether that's virtual, and let's see how students react to the ease of accessing education online versus, as we were discussing earlier, Steve and I about MBAs missing that network effect of actually being close to each other. And then senior housing, I think, is really, you know, we used to be very positive on the low acuity stuff, but the reputational damage that could occur because of the deaths in care homes, I think, is going to be fascinating to monitor. And long term, we just see real issues with regulation and intervention there, and risk rising. Hospitality, obviously, hugely negative. Medium term, hotels as well. Long term, what happens? I mean, do we go back to business travel as we used to have it? Even before the COVID crisis, we were really considering our carbon footprint. And as you know, investors were telling us they wanted their portfolios to be carbon neutral by whatever date. We were anticipating the point at which they said, and also, what's your carbon footprint as managers? So I think the use of business travel was already going to decrease, and this again accelerates it, maybe. If we move on to the next slide, if we can, or 2 slides ahead. So what does all this mean for how we were looking at our real estate portfolios? Well, what we have here is what I'm sure a lot of fund managers have, which is a sort of hypothetical model portfolio for sort of a core investor, unleveraged, unhedged. Obviously, for particular investors, we can do all of that refinement and give them a client plan that's specific to them. But this hopefully helps us articulate what we like and don't like. The dark grey bars show a strategic bandwidth for investment, which is influenced by the benchmark. The benchmark is what we think the investable universe is, based broadly on the benchmark providers, but adjusted if we think that they're remiss in capturing parts of the market that we can access. We were fairly neutral on a regional level anyway before this. We were neutral to North America, slightly underweight Europe, slightly overweight Asia Pac. And I think we've taken the decision, I'd love to debate this with anyone on the call, not to change that radically, because we think that COVID's a global pandemic, and yes, we go in and out of it in different waves, but fundamentally, do we have enough conviction to make broad regional changes based on that? Now, as we come through the crisis, if we see big differences in the public health responses, and indeed in the sovereign credit worthiness of different markets given the debt that they're taking on, that may at a macro level start to really impact that regional tactical allocation as shown in the light green bar. And I suspect it might actually. But when we did this about a month ago, we didn't really feel we had enough knowledge to make a strong conviction change. But where we do always make strong conviction bets is by sector. And that did change with the COVID crisis. So you can see our strategic band for industrial sits above the benchmark because we think it's a maturing, institutionalizing market. And we remain sort of halfway up. We increased it a little bit. We'd actually brought down that tactical weighting just because we felt industrial was becoming, you know, quite overbought. It was, you know, becoming more and more expensive relative to the other sectors. And we were seeing the supply response kick in. You know, COVID makes us more positive on the sector, so that's nudged up again. Resi, we were overweight and remain overweight, but the mainstream Resi would look higher than this. I'll show you on my next and final slide how the niche sectors have brought that down, because we used to be very positive on student and senior living. Office, you can see for core investors, we're always strategically underweight, not because we don't love the sector, but because we think, you know, it's high amplitude, you play it in cycles, and it's something we do more in our value add programs. But actually we remain positive, and I guess we would still remain positive on medical office, although we do have concerns about healthcare assets and the potential for hospital bankruptcies in the States. I mean, how different we are to 2008 when, you know, a hospital as august as Johns Hopkins could be asking the government for a bailout because of their dependence on elective surgery. So it's kind of ironic, isn't it, in the middle of a global pandemic to say that you're becoming more cautious on healthcare assets. Retail, I said before, my favorite phrase, it's an accelerant. We have down-weighted even more, both the strategic ban and the tactical allocation. It's obviously hypothetical because you couldn't sell it today, but we wouldn't be putting much into our portfolios. And then alternatives, if you go to the next slide, we've tried to sort of expand that out a little bit. So I think this is where a lot of the interesting stuff is going on the back of COVID. Yeah, so you can see where those hotel tactical allocations are. There will come a point when retail and leisure hospitality looks really interesting. I suspect it's not going to be for a little bit of time, however. So we're very down-weighted, partly, as I said before, because of COVID, but partly just also considering this heightened interest in carbon footprints and travel, and how far that was going to really survive. Senior living we've brought down. We think there are big reputational and regulatory issues in that sector. Medical officers still overweight, but obviously this is very much going to be dependent on what happens in the hospital sector, because they tend to be, not to be pejorative, but parasitic on the hospital locations. Student housing we've brought down to neutral. That was overweight, so that's a big call. Just wondering if, even if universities start teaching again, or continue teaching virtually, whether students are really going to be back in full flow until January. And we also worry a little bit about the dependence on affluent, international students, how far this is going to increase nationalism and change the willingness to accept people moving in quite the same way they used to. Self-storage, no change, leisure down, obviously. And data centers, as you can see, our strategic band is well above the benchmark. We think it's an expanding sector. It's maybe hard to get hold of. It's very small in absolute terms, but obviously everyone needs to make Zoom calls now. So we're very positive on the sector, will continue to be. So that's I think it from me. That was a whistle-stop tour with a bit of the macro outlook and where our tactical positioning is. Let me hand back hopefully to Andy, who's now on the call.
Yeah, thanks, Sabina. Andrew, are you online now? Andrew, can we hear you? You're very quiet. Okay, so I don't know if we can hear Andrew or not. Andrew, if you are there and you can chime in, please do so. But perhaps at this point, Sabina, we did have some kind of general questions as well, which are on the screen now. So perhaps we'll kind of run through those if that's okay. Just as a reminder to the audience out there as well, there will be an opportunity to ask questions, and that time is kind of now. So if you do have any questions that have been sparked over the last 20 minutes or so, or as we kind of go through the next kind of 10 minutes of questions, please do put them in the questions panel in front of you, and we'll address those to Sabina and to Andrew if we get him. So Sabina, thank you very much for that. One of the things which we've kind of been seeing and reading about is, that the government basically not quite doing a Draghi, but basically lots of international governments just recognizing and following through on the fact that they basically need to increase the money supply and try and keep the economy going in any way in which they can. What are your thoughts about that? How that might wash through into the investment markets?
I mean, insofar as it's keeping bond yields down right now, it's positive for us, right? And it's forcing some interesting pricing. I mean, the German office market is a classic example of that, where we're still in the market and you're seeing prices paid that are quite bullish based on very, very low bond yields. I'm looking at the top question here. Is this QE? Yes. Inflationary effect of helicopter money. And for anyone who's on the call who knows me knows that I started my career working for Roger Bootle, who wrote a book called The Death of Inflation. And I must admit, I still believe in a lot of those structural forces that are out there that are deflationary. And I don't think that I'm worried about inflation right now, just because the size of this demand shock is so enormous that I think it offsets. I think you need the money supply expansion to keep us at inflation of 1% to 2%, frankly.
Yeah.
And even if we were to get inflation that was slightly higher, maybe 3% to 4%, that's not necessarily a bad thing, unless you've got a capped and collared lease that's below that level, because we're so indebted. But I just really don't think it's something I'm worried about. A, because we know how to get rid of inflation, where we don't really know how to get rid of deflation. And the kind of numbers that I'm looking at on base case, I didn't show any downside charts, are so deflationary. That to me is the thing that I really am paranoid about and worried about.
Yeah. Do you see, how deflationary do you think things might get?
Yeah, I mean, on the base case, we have deflation this year not just in Japan, but in places like South Korea, places potentially Germany might flirt with it, places that already had very low price pressures. On our medium and severe downside cases, we have, on the severe one, very severe deflation. Like I'm talking, -3 to 4% inflation for a couple of years in most major markets. So that really does look a little bit like Japan early 90s, because you've got such a sort of credit crunch and such a destruction of supply potential relative to incomes that are falling. So I think it could get bad. I mean, that's not the base case though. And actually, one would hope that the recovery starts as soon as Q3. So I don't want to sound overly bearish. But that is what I do worry about. That's my sort of, my greatest fear.
Yeah. And what kind of theory or research are you basing your the shape of your recovery on? So we've heard about, what kind of bounce will it be? Will it be a V-shaped bounce, or an L-shape, just kind of stay down, or you've got the kind of the tick kind of swoosh recovery here? What kind of data are you basing that on?
Yeah, it's really hard, right? Because the economic data right now isn't great, because just publishing national statistics in a time of lockdown isn't easy. So you do have survey data, which probably overstates, but what we're trying to do, and this is why it's so hard right now, and I would put even more caveats than normal around the macro slides that I showed everyone, because you're not just forecasting macro, you're forecasting public health. You're forecasting the epidemiology of a virus about which we know very little. I've had an antibody test which shows something, but it's not reliable. And I don't even know, even if I do have antibodies, whether I can't catch this again. So that's a very basic level of not knowing. And so trying to predict whether there's going to be a second wave of infections, does that happen when we lift lockdown, or does it happen in the normal flu season? Because this is susceptible to weather as other flus are. So there's this extra layer of complication. But what we've assumed in the base case is you get a gradual lifting of lockdown in the next couple of weeks, very softly, then gathering pace over the summer, that you do therefore get a second wave of infection, not necessarily worse than the first, but you do get it. And therefore there might be partial lockdowns, partial sort of measures taken in the second half of this year. So you get a recovery, because things are so bad right now that the sort of Q on Q annualized numbers will look pretty chirpy, but you're still kind of disrupted. And we all know, don't we, that when we go back to our offices, it'll be half in, half out, that the teaching will resume, but it'll be virtual maybe, that it's not going to be business as normal until sort of start of next year, when maybe you get an antiviral drug that works, or maybe you get a vaccine. So we're assuming it's very bumpy. And what worries us a bit about the second wave of lockdowns is actually feeds to your next bullet point on impact of supply chain disruption, which is this lockdown or set of lockdowns, everyone was kind of locked down together. I mean, maybe not China, but pretty much everyone else. But what happens if, given what we know about dependence of global supply chains, if, Germany gets a nasty second wave, say it has to lock down for a month, but Czech Republic is still open, and then Germany comes out, but then Poland's shut because they've suddenly got, and it's not as coordinated, and that could actually have a worse impact on manufacturing than this current rather coordinated version. And actually with a big impact on logistics. So
starting to get quite a few questions coming. Obviously we've got the ones on the screen as well, but jumping into one of these, it's related. Any view on cap rates, especially in core offices?
Over what, I don't know if that person can answer over what time horizon. Evidently right now there is price disruption, right? Because when we're in the market, either there's no market at all for the poorer quality assets or the asset classes no one's interested in right now given the risk. But even in the really good quality stuff, without naming nails and deals, we are managing to chip prices by, say, 5 to 8 to 10%. And that's some good quality stuff, because if people are desperate to sell right now, there's a handful of people who'll still do the deal. And so what would that imply for cap rates in the near term? The question that bugs me, and I think this is going to be fascinating, we've got a big brainstorm call this afternoon, is what happens to cap rates? What will they be next April relative to January of this year? Do they come out, like do they rise? But then as the market recovers, look at the stock market, as we come out of lockdown, for the prime, the better quality stuff that people see as a risk averse, do they fall back to where they were in January of this year, next April? Do they even come below that? I mean, if you believe the macro forecasts that say bond yields at basically zero in Germany, for the prime CBD office, where would that get to? Despite the fact that we know that most financial institutions are not going to be willing to take the space they were back in January. In other words, what's the trade-off between property as an income provider relative to a lower risk-free rate versus the impairment of rent growth going forward? So that's a really non-answer, but it's, yeah, for now they have definitely risen for sure.
Yeah. Well, lots of questions actually coming in. There's several of them are related, so I was trying to pick out ones that we kind of haven't touched on already. But one here, from, I haven't got a name, but somebody says, I'm wondering what is the time horizon of your tactical allocation? For example, the hotels seem under allocated, but may return to strength within 1 to 2 years.
Yeah, so we refresh it every 6 months. So that tactical is really meant to provide guidance to people buying over the next 6 months. And they can change, right? I mean, the tacticals, something can look really unattractive for a while, and then suddenly it goes from being very negative to very positive because distress emerges, or, you know, they can be quite large swings. They are informed, these numbers aren't just us making them up, they are informed by us doing quantitative real estate forecasts and a relative real estate forecast. In other words, looking at the difference between the forecast and the required return is what drives those. So it's the forecast changes, but also the required return, which is heavily influenced by the risk-free rate and our forecasted depreciation, which with structural obsolescence becomes a big deal. That's what drives it. But 6 months is the answer.
Okay, great, thank you. What are your views, or the House views, I guess, on the overall impact on vacancies and rent levels in the core CBD office market?
Yeah, so I think what's really interesting about core CBD office markets is more than almost any other type of real estate, they're very influenced by what's going on the supply side, right? And big towers being built and leased up or pre-leased. And one of the things that's been surprising to us, or we've been trying to get our heads around, is how, because you can kind of model, you know, if I get from the OEF a nice sort of central London employment number for finance and tech, I can model my rent fall, as it is probably likely to be, fairly easily. But the question is what's happening to construction? At the start of this, we thought construction would all grind to a halt, and actually it hasn't, both for offices and for resi, which has been surprising, because at first we thought, oh, maybe you're going to get actually a bit of a pop in prime CBD office rents, or any market where there's a limited supply of sort of, you know, grade A vacancy in a year and a half's time, because demand will come back and you'll have had that restricted supply. That doesn't seem to be the case. And what's really interesting is we thought, gosh, maybe this is going to halt permitting, and how do you get hold of your local authority? But and this is coming more from the residential side, but that doesn't seem to have slowed down either. So we are wondering a little bit if supply side is going to be as disrupted as we had initially thought. I mean, there are exceptions and pockets. You know, there's places in the US where they're seeing big labour shortages because of immigration more, but in general, it's held up better than we thought. So vacancy higher, and maybe not the helpful constraint on construction that gives a bit of a pop during the recovery.
Okay, great, thank you. And I was wondering what's happening with all those developments. A question on a different sector, but what is your view on the residential affordable sector within the Eurozone over the next 5 years or so?
Yeah, I mean, like pre-COVID, we loved it. I mean, we've got, you know, we're very big in this sector. We love affordable housing. And maybe this is an answer that's more to do with politics than anything. I do wonder, when we come out of this crisis, what it does to the tone of politics, right? And this maybe is a UK specific question or answer. Do you think it will be as easy for us as landlords to put up rents on the kind of residential that caters to key workers? And I just wonder if there's a kind of a resettlement between cohorts. What's been fascinating to me is to think about what happened in previous crises. So if you take, for example, the 1970s with the oil price shocks, and, you know, government very much on the side of the landlord, bringing in upward only rent reviews to protect our income. It's been the reverse this time, right? As soon as this crisis happened, it was like, we've got to protect the tenant and restrict your right to evict or enforce. So that seems to me a very interesting change, and if sustained, makes your cash flow modeling very different, I think. Not very different, but it changes the balance of risks around what you thought was potentially certain income. And I think in terms of regulation and social settlement, affordable housing would be quite an easy target, wouldn't it?
Yeah, absolutely would. Absolutely would. Couple of questions on how this may influence the US election, but perhaps we might perhaps we might move on to that in terms of a question here. There's a couple actually around emerging markets in different guises, but one says, thank you very much for your presentation. Could we expect higher investments in real estate in emerging markets due to the strength of the US dollar versus local currencies? Or more investments in developed markets, for instance, in the UK or USA? Any thoughts on currency movements in emerging markets?
Yeah, I mean, the dollar strength has been quite puzzling to me, so I'm not sure I'm the right person to answer because it's been so flummoxing to me. I think the reason to invest in some of the Asia Pacific emerging markets is the fact that because they're so much more used to having epidemics, they're so much better prepared. I mean, you look at the public health response in some of these smaller Asian markets. It's been phenomenal compared to somewhere like the UK. So if you think this is something that's not going to be once in a lifetime, but maybe once in every 10 years you're going to get one of these, then that would be a reason. I often think currency is a slightly odd reason to invest in real estate, because it can move against you as fast as not. And I also would add with emerging markets, those that are dependent on US dollar funding, if I'm telling you that my downside scenario is motivated by a credit crunch, those countries do not do well in a US dollar credit crunch.
Okay. Have you looked at Africa? So we have a question here. Have you conducted a forecast of government bond yields in Africa at all?
Sadly not, because we tend to be a core investor. Something like 80–85% of our capital is core. So the fringes of risk, we just don't cover it. Sorry.
Okay, no, that's fine. That's fair enough. And another question here. Excuse my ignorance, but since COVID-19, I've not heard a single mention of the ongoing Brexit negotiations and future scenarios were not included in Sabina's projections. Is the UK economy at a risk of being dealt a further blow as we pick up on Brexit?
Is it a further blow? I mean, like all the stuff that would have been terrible about leaving without a trade deal on December have already happened. The supply chain disruption and the massive rise in unemployment. I mean, I think it's sort of, there's two ways of looking at it. You know, you've got Boris Johnson, you've got the Conservative government polling at its highest level of any Conservative government ever in history, including Margaret Thatcher at her height. There is an argument that they choose to take the pain because they don't have to face an election for another 4 years. And there's also an argument for saying that, I'm not saying this is right or wrong, by the way, I'm not making a party political point, I'm just saying that you can imagine one of the ways in which they think that if the EU is about to put together a massive, effectively Marshall plan to bail out Italy, that they want to be far away from it, so they'd rather take the upfront hit. I think in a sense, pre-COVID, if we had left without a trade deal, or even with a trade deal, and that had caused a recession, that would have been very visible, right? Very visible relative to the rest of the world. If you leave and that causes economic pain, but you're already in the worst recession since the Great Depression, arguably it's easier to hide it. So I'm not sure this does delay the Brexit if we do ask for an extension. Right or wrong?
Thank you. A related question, I guess, but one here. Will the UK depend on how the EU countries come out of the crisis? Yeah,
we're an interrelated world, right? And I think everyone, this is what it teaches us, that we depend on everyone else. The kind of the privilege of being in the position of the US and the UK, and why it kind of makes me angry that in a sense we've slightly squandered it, is the more West you are in the world, the more chance you had to observe what everyone else did and what didn't work, and therefore your response should have been better. And the beautiful thing, or the sort of the advantage we now have in the UK, is if we hold this lockdown for another couple of weeks, you will see whether lifting at the margin lockdowns in other European countries does cause infections to rise, and gives a bit of time to sort of put into place proper public health provisions. So yes, we're dependent, and hopefully one should learn.
Yeah, Absolutely. Interesting what you were saying about, you know, the way in which the Asian countries have managed the whole pandemic. It doesn't seem that long ago when we were sat, you know, kind of, and there were cases in China and Hong Kong and Singapore, and we were saying, well, should we be allowing people from Hong Kong to travel over for our courses? And then, you know, it was only about 2 weeks later when actually they were kind of, you know, on the way down, and everybody else was severely on the way up. So yeah, it's been really amazing to see that. Okay, questions still coming through quite thick and fast, actually. So I'll shoot some of these off. If you're you know, well placed to answer them, then great. If they're not your area of expertise, then feel free, we'll keep on moving. Are we likely to see an increase of onshore supply chain requirements and a move away of just-in-time supply chains? If so, what do you think the impact on the real estate market in the UK might be, and globally? So do we think there's going to be an increase in onshore supply chain and less just-in-time?
Yeah, whether it's truly onshore or whether it's a truer form of globalization rather than being more mono-dependent on China, I don't know. I suspect there might be some of it, particularly for whatever's deemed to be essential kit. Like, would we want to have a capacity to build or to manufacture PPE in this country? I was talking, actually, interestingly, to a friend of mine who is very senior in the healthcare industry and the pharmaceutical industry, and said, well, even if you wanted to onshore some pharmaceutical manufacturing, I mean, maybe it's not ideal that everything's basically, you know, pumped out in India and China, but prior to COVID, if you had decided which pills you wanted to manufacture in the UK, you wouldn't have had one random pill that does malaria, another one that does Ebola being manufactured here, because they wouldn't have been seen as the most relevant ones to do. So I find that, yeah, it's going to be interesting to see whether it's onshoring or more diverse globalization. The idea of having from just in time to just in case inventory and stock, I think, is fascinating, because it would imply a greater demand for warehousing, right? And yep, it would also imply lower margins, because the reason why you have just in time is because it boosts your margins. And who carries that cost? Does that cost come through in poorer corporate performance and share prices, or does it get passed on to the consumer? Because that could actually be a little bit inflationary, because someone's got to pay for that resilience. So I think that's really fascinating. For the UK, I just think it, you know, extra warehousing wouldn't surprise me at all. And you're seeing it right now, like, so what are we doing with the summer stock of clothing that no one's buying, or the beer that's going stale in the pubs? I mean, there is an issue with the current warehousing requirements around the world.
Yeah. That's certainly going to change. Where do you see the best good quality distressed assets that can be acquired during these times? So which markets and sectors do you see the best good quality distressed assets?
Well, are they anywhere yet, right? To quote the head of Blackstone, he doesn't think there's going to be good quality distress for a year. And you think about how it operated in 2008, it's a while before these things fall into place, before loans are defaulted on, they go to special services. There are interesting buying opportunities. I think, you know, patience, I would imagine that question will be more interesting next year, because I don't really see distress right now. I see a bit of minor price tripping, but I don't really see distress. And if there is pricing on parts of retail, it's not quite where it needs to be yet. Interesting to hear if there's any other views though.
Okay. What do you think about emerging Europe? So the non-Euro countries like Poland and Warsaw in particular. So this particular person's asking about Warsaw prime CBD space. Do you have any views on non-Euro countries in general, Poland in particular, and specifically in Warsaw?
Yeah, so we've always been very positive on the CEE, and partly that's to do with many years ago now, our acquisition of ING Rhyme, who had a very established CEE business, and Poland in particular. But I have to say, we don't really do a lot of CBD office market investment. It was, to our chagrin now, like a lot of shopping centres early on, and then now it's far more focused on logistics. In general, remaining positive, partly because we're in logistics and partly because we're mostly in Poland, Czech Republic, a little bit in Hungary. Yeah, so probably not the best person to answer on CBD offices in particular, but positive on those markets.
Yeah, sure. Okay, a couple of questions regarding institutional investors. So the first one, do you have any views on projected investment from private institutional investors in affordable housing in the UK?
Pre-COVID, positive, and I would imagine still so today.
Yeah,
because the fundamental supply and demand dynamics are still there.
Yeah. And do you have any expectations on investments from sovereign wealth funds into emerging and developed markets going forward? How do you think expectations on investment from SWS might change?
Yeah, so the sovereign wealth, it depends very much how they're funded, right? So you've got major sovereign wealths around the world that are basically commodity fueled. So the Norwegian sovereign wealth fund, some of the players in the Middle East and parts of Asia, for whom the current incredibly low oil price is problematic. So I think it's much more about the dynamics internal to those funds rather than the attraction or otherwise of particular real estate markets. But for those that aren't dependent like that, we're still seeing great demands. And to the earlier question, people at the most sophisticated end who are coming to us and saying sort of, when do you think the interesting opportunity is going to emerge? We're ready for them. So there's plenty of capital still there.
Okay.
Which is encouraging.
Okay, should we make this the last question because we're starting to come up on time? How do you see the core plus versus value add trade-off evolving in the residential sector? So how do you see the core versus value add trade-off in the residential sector?
It'd be good to know a bit more of the context of why, like what that question was getting at. But I mean, in general, there is a rush to core, isn't there, when people are risk off, and then it swings back to value add, and that would be true of resi as much as anything else. I tell you where, not to stress, but where you are seeing things different is the leverage availability for value add, and the sort of, especially the more towards the development projects, has that landscape has changed markedly over the last month. So I think it's more people will be forced to do more core. Doesn't mean we wouldn't want to do value add, it just we might not be able to get the financing for it.
Yeah, so revert to core. Sabina, thank you very much for answering all those questions. There have been a couple more questions as well. I think we've covered most of the main points. There's a couple of specific points in there, but I think we've covered most of them. So thank you very much for covering all of that. I don't know what happens with Andrew. I think he might have some laptop issue or something like that. So pass on his best regards when we see him. I just want to kind of finish off by just giving a very quick plug to our executive education course in real estate. So this program was originally due to run at the end of March, so we needed to reschedule that. So the situation is we can reschedule that until November. So most people have transferred over to the November iteration, and obviously we hope that we will be live and good for teaching on campus in Oxford in the autumn winter. If not, the next dates after that are actually in March of next year, so we can transfer people again if that works for them, or we'll kind of pick up people there. So really just kind of give a very quick swizz through that. This is a one-week program for people working in real estate and real estate investment in particular. It's really a strategic view. So obviously we have Oxford researchers and Oxford aligned researchers involved. We have global industry leaders from a range of different organizations that changes each year. But importantly and interestingly, normally we would say this is a kind of real selling point. You'll be mixing with around about 40 people from 20 around the world. So for us, it's going to be interesting to see how those dynamics. The program is designed for people who are already fairly experienced in real estate. So typically they'll be 10 years into their career, looking to take on a director strategy level role. I'm looking for a kind of recap and a refresher and a global overview of what's happening. We have some large landowners, we have sovereign wealth funds, we have family businesses, we have developers, we have funds of all shapes and sizes, and from all countries as well. We have corporate sponsors, such as the ones you can see on your screen now, have all sent multiple people in recent years, for which we thank them. The next dates are on the screen at the moment. Obviously, we will keep people informed on our general email list as to what's happening with the November and March dates, and hope that we will see some of you there, if not before. Really just wanted to thank everybody that's on the call. We've had a record number of people joining the call today, actually, so about 400. So thank you very much for everybody who's been on the call. Thank you for all your questions. Sorry if we didn't answer your specific question. So we tried to cover most of those. And particular thanks to you, Sabina, for running through that, and particularly for going through all those questions at short notice. So thank you very much. Thanks, guys, and we hope to see you on our next webinar. We'll send details of that in the email soon. And just to recap, there will be an email which everybody will get after this webinar today, which will come out in the next couple of days, which has a recording of the webinar for you to review any of those graphics or people on there. Thank you very much, and see you all soon. Thank you. Bye-bye.